freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
Hello and welcome to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Adam Penn, here with Dustin Bailey. How are you, Dustin?
I'm doing great, Adam. How are you?
See, it's hard to always respond with the same thing.
You know?
I figure we got to do this one backwards today because you're going to lead the interview.
It's funny that you did that. I was taking a drink of water, not actually thinking you were going to start saying that. And I think we're going to leave this in. This will be.
You didn't laugh in the beginning, so I think we can have the intro be the intro.
I think we can. I've
tried this before, and you stepped over me by the time I got to the "How are you?"
Well, so did you time it intentionally when I was taking a drink of water? Was that?
No, I just saw you were about to start talking, and I thought I could cut you off.
Okay. Well, I appreciate that. No, that'll be good. I don't know. We can go right into this week's episode. I think it's a little bit longer anyway, so we won't banter as much as we usually do. But we've got a guest. His name's Matt Paulson. I'm very, very excited about this. He tweeted about wanting to go on a podcast tour back in November, and I reached out and wanted to schedule something. We've had to reschedule twice now, and so this interview's been a long time coming.
Yeah, I'm a little amazed we got it, given that I think he only did like 10 of these.
Yeah, no, I was surprised at that because he's got a decent following, and I was expecting that he would have done like 20 to 50 or something like that. And I think he told us that he had only done a handful. So, I've been very excited for today. I've been looking forward to talking to him. For those that aren't familiar, so Matt's very successful entrepreneur. He's the CEO and founder of MarketBeat, which is a financial news analysis website. Go check it out, marketbeat.com. But he has his hands in a lot of different things. And that was one of the reasons when I saw his tweet back last year that he was doing this, I thought it'd be interesting to get him on because he's also a commercial real estate investor and is a GP in, I think they've got over 2,000 units of apartments there in the Midwest, I think mainly in the Sioux Falls area.
Creston Capital, right?
Creston Capital, yep. Again, he's a super interesting guy. Would highly recommend everybody go follow him on Twitter. Post some entertaining stuff. I think he's funny. He can kind of post some things to try to get a response out of people and rile some people up every now and then. But then also drop some pretty good business advice and a lot of stuff focused on online businesses and newsletter marketing and things like that. But he's just a good all around follow. So, well, with that, I don't know, Adam, if you got anything else to add, we will dive right into the interview.
Yeah.
All right, Matt, welcome to the show.
Happy to be here.
Yeah, man. Thanks so much for doing that. I know it's been a long time coming. We were talking here before we record. I think you put out your podcast tour request for invite back in I'm pretty sure it was November, right?
Yeah, there's been a whole podcast tour and a consulting tour since then. So it's been a little while, but happy to finally do this.
Yeah, the consulting piece is actually something I want to ask about here in a bit. But I guess first, just for anyone that's not familiar with you, would love just give a little bit about yourself and background. I know you're in a whole lot of different businesses, whole lot of different things. So just love to hear. Tell everybody a little bit about yourself.
Yeah. So I'm 40 years old today, and I've been making money.
Birthday.
Not today. Like I'm now 40.
Oh, okay.
But like I've been making money on the internet since I was like 10 in the 90s. So it's been a very long road of like trying to like build a living on the internet, like back in the day of having a little website that had ads before Google AdSense on it to today, like running a giant financial media company, 50 million in revenue, 20 employees, web, email, SMS, YouTube, several million subscribers across all the platforms, and like have kind of stayed on that same path. Then have, a couple other like hobbies, like not hobby businesses, but like side projects. I run a venture capital fund on the side to invest in technology companies in the Midwest, Great Plains region. Then I also invest in commercial real estate with the money that I make from MarketBeat. So with media companies, like there's not always a lot of enterprise value or exit value. It's kind of more like, an agency where like they just don't sell for a ton of money. So my retirement plan is to take the money MarketBeat makes, throw it into commercial real estate, and I'll have plenty of money to retire on then.
I think I've heard Kiyosaki quoted before saying that, have a cash flowing business, but take all that cash flow and spit it off into real estate to create that long-term income.
Yeah. I mean, take the non-flywheel revenue and then invest it into something that is the flywheel, right? And that's worked out pretty well for me so far, at least.
That's awesome. Yeah, that strategy is solid. I don't know, Adam and I've got a friend that runs a Amazon DSP, and it's kind of the same thing, right? There's no terminal value in that business, and so it's a pure cash flow thing. And take that and then throw it into something else. And I do want to dive into that a little bit, but I have a question as far as like MarketBeat, and just real quick, and this is more my own curiosity than anything, but with the financial publishing industry, sort of, where do you see that going with AI? Because I know you're involved in AI and kind of paying attention to things there as well. So sort of like, what's your outlook on that industry in the face of AI?
Yeah. I think the investment tools business is likely going to be disrupted because the AI tools that just have access to all the data are frankly better than kind of the tools that have been built on the web over the last 20 years. So like Perplexity is a much better like financial research app than frankly MarketBeat is, or any of the other kind of tools website is. So like, yeah, those are going to get disrupted. Thankfully, MarketBeat's primarily in like the marketing and attention advertising business than it is more the tools business. Like if I were researching a stock, I'd be doing it probably on Perplexity because they've got the best stock data over like older sites like MarketBeat. Like that is definitely like happening. But there's also like people, you don't always ask, like, look to AI for your opinions. Like you really like any like AI in the world of AI, like taste is still something that really matters, and expertise, and like the information publishing industry. Like I think that's going to be just fine. Like, because people don't necessarily want to research, they want to be told what to do. And maybe some people let AI tell them what to do, but largely, like, I think there's still a space for that.
That's really good. You mentioned taste. I feel like that's something I've heard a lot of people talk about. That's now the thing that is when the execution is the kind of being commoditized. Taste and knowing what to execute becomes a lot more important.
Yeah, because like you've seen, like you see the tweets of like, hey, I just vibe coded a Salesforce replacement, and it's like, yeah, that's cool, but like people don't buy Salesforce for like just the fact that it's a CRM tool. Like they buy it for the giant infrastructure and the accessibility and the support, and like there's a lot more like to a company than a product, and people that vibe code often miss that. Like, yeah, I can make a stock research vibe coded app pretty easily because the data is out there for anybody to buy, like from Intrinio or NASDAQ data link. Like anybody can go get the data now. Like it's really easy to get. So then based off that, it's really easy to build a vibe coded website. You can't vibe code 6 million email subscribers though. Good luck with that. But people don't understand, like the value is not in the product, it's in the audience, and like you can't vibe code that.
That's really good. I guess I want to dive into the real estate side, but you mentioned an audience, and I think you mentioned before we hit record, or maybe after the consulting business, and I'm curious about that because I think you had it was a tweet, right, that basically turned into almost a 6-figure business from literally just one tweet, right? And I'm curious, like how a personal brand and having an audience, I feel like that's a little bit of an illustration of the value there. But like, what did you take away from that?
Yeah. So what happened was somebody on Twitter said, I want to buy an hour of your time. And I was bored. So like, I just like made a Stripe link with like the biggest number I could think of that somebody might pay for an hour of my time, which was $2,500. And then like 25 people like ended up clicking on a link and buying it. I was like, that link was just for that one guy. Like the rest of you weren't supposed to do this, but it's like, fine, I'll take your money. And then I raised the price and I put an upsell on there. So some people paid as much as like $6,000. One guy paid $9,000. And like, okay. Jeez. So I got like 25 clients. Total revenue is like $100,000 from it. I've done with almost all of the calls. Like some people bought like 3 calls. So then like, call every month, January, February, March. And I've got a few left, almost done. And then somewhere in there, I got signed up for intro, because they thought, well, if somebody's paying this guy now, like they'll pay him on intro. And I've had a few more come through intro, and it's kind of become a whole thing, but I'm also kind of tired of doing it, and like it's kind of been a distraction. So like I'm ready to press the pause button on it for now.
Sure.
The lesson that I take away from it though is, there are a lot of like accounts on social media that have a very like wide followership, like where you've got a ton of like, couple 200,000-300,000 followers, but like you want your audience to go do something. It's really kind of hard, like there's not a lot of intent behind like following. You just like be like find an account entertaining.
Yeah.
What I've found with my followers is like there's a lot of depth to it. Like if I talk about an email marketing tool, like they might go get 20 customers the next month because like people trust that like when I'm talking about email marketing, I know what I'm talking about. I've tried the tools, like they're good, and like if I make a recommendation, then people take that seriously.
Sure. And I guess that applies to an email list as well, right? Like you can build a large number of email subscribers, but if there's no intent behind it, then what's the real value, right?
Yeah, that's kind of always a disconnect that you see with people that have like media businesses or audiences. It's like at the end of the day, like that audience exists because you're running a business and you're trying to make money. And sometimes people don't always like remember that, and they think like, oh, I just want to keep my audience happy, and I don't want to be too promotional, and I just want to make sure everybody has a good experience. And it's like, hey, we're in business.
Yep.
There's one goal of a business, and that is to make some money so your kids can eat and go to college.
Totally agree. Well, I do want to hit the real estate angle here. So I know, obviously most people, I think if they follow you online, which by the way, to give a plug for Matt here, go follow him on Twitter. Like it's very entertaining. I post some great stuff, and I personally enjoy it a lot. But I think most people would know you from MarketBeat and sort of that online marketing, online business world. But you're also a GP with Creston Capital, correct?
Yep, Creston Capital out of Sioux Falls, South Dakota. And we've got 2,100 apartment units. We have we own like a mall. We own some random commercial buildings in town. A few kind of QSRs here and there. Some strip malls, kind of normal stuff. And primarily geographically concentrated in South Dakota. But like, at one point, we thought it was a good idea to roll up Starbucks. We've got like some Starbucks QSRs and random places.
So is that kind of the buy boxes like Sioux Falls and different asset types within that, just given
Yeah.
sort of
we have, I guess we have an apartment complex out in Rapid City too. So like,
right.
we'll go regionally, like as it makes sense to. But yeah, mostly local stuff that we can see. Like my thought is like, if I'm going to be going out and buying retail in like Florida, like I might as well just invest in a Blackstone REIT. Like, unless I can see it, like I probably don't want to invest in it very much.
Sure. So obviously Sioux Falls isn't exactly a gateway market. So is there a macro thesis there, or is this just you want to invest in something that's local?
Yeah. Well, the community's growing by 5% a year. So good growth. All the apartments are full. I think, it's a good growing market. And like, as a kind of Midwest Great Plains community, it's 250,000 people. We're not very spiky. We don't have the bubbles. We don't have the bursts. So it's just kind of a slow and steady up into the right market. So like, we haven't felt like a strong urgency to expand to Minneapolis or Omaha or Des Moines. There's just plenty of opportunity here. And this is pretty new for us. Like we didn't really start buying stuff till 18, 19. And then during COVID, when rates were in the threes and everybody was scared, like that was like a boom time for MarketBeat and a boom time for my partner Kevin through his Verizon business. And we were just sitting on cash and saw rates in the threes, and like we should just buy as much crap as we can right now because like we both have a pretty good reputation in town. So like all the banks want to work with us, and we have a guy named Rocky who's our banker at First Dakota National Bank here in town, but he also negotiates like all of the loans for us with other banks too. And we were able to lock in some rates for like 7 years and then put like caps on the rate increases at refinance and like really lock in some like fantastic financing for a long period of time.
Are you guys still holding any of those things you initially bought, or did you sell when prices ran up?
No, we're holding basically all of it. We sold a couple of little things here and there, just opportunistically, but we're not flippers. Like we're kind of buy and hold and just want to pay down debt and take distributions when it makes sense. And
Sure. So what was your initial intro to commercial real estate? And what was kind of like the first deal? Were you active? Was it just like a passive LP investment?
yeah, I did like one LP investment, and then like I met with some of the like local syndicators, and I just wasn't very impressed with what I saw. And like there are a couple good ones, but I just like I figured like I just need to figure out where the fees are, and then like I can tell like how much these people are making off me. I just like I don't really want to pay these fees, so like I'm either not going to do it, or I'm going to do it in a way where like I'm playing a different game.
Sure.
And then had a mutual friend introduced me to Kevin, and Kevin's like, well, so his business is called Victra. It's like the largest chain of Verizon stores in the country. There's like 1,500 of them. He owns like 20% of it. But like through the mergers over the years of like different Verizon groups, like at one point, like it was him or another guy, and like one of them had decided to be CEO, and like Kevin was the guy who wasn't CEO, and was just like, okay, you're in charge. I'll be a board member, and I'll go find something else to do. Kevin decided he was going to go run his own family office, which he did. So now he's got like a car dealership, and he's got like 80 Anytime Fitness stores or something like that. And he's got a few bars and does like real estate development. So he and I met. I was like, hey, I want to invest in real estate, but I don't want to pay syndication fees. And he's like, well, you can be my general partner. I was like, that sounds good. Let's do it. So we started like, 1 or 2 apartment complexes, and it just kind of snowballed. And I think we're up to like 35 commercial properties now.
Wow.
Yeah, a couple thousand apartment units. We're building more. We do new development, and those have gone well.
And you guys are vertically integrated, correct?
We don't own a construction company now.
Okay.
Well, we do like GC. Like if we have like a strip mall project, like the smaller stuff, we'll GC it ourselves. But like we don't we don't have our own subs.
I'm curious then your perspective on the there seems to be in some ways a religious divide among the use of third party management versus you get to a certain scale and you need to be managing on your own. Like what's your view on that?
Yeah, we do our own property management, and I think that's for us it's the right decision. Like if you're smaller, like yeah, outsource it. But like we didn't think the quality was quite there in terms of what we were looking for. Like we want to like have Class A apartment properties, and that requires Class A management. And like when we started, we only had a couple properties, and it was outsourced management, and we just didn't feel like we were getting, like we didn't feel like our properties were getting enough attention. Or we should just hire people to do it ourselves, and we'll figure it out. And like we do our own property management now, and I think that's one of the reasons our occupancy has been like above kind of what the market is. I mean, we're at 95, 96 when the market's at 90. And I think it's because like we just have good people at our properties, and like there's always somebody there, and
it makes a difference. Adam and I've got friends who take sort of that same view, and they feel that you manage something that you own a lot differently than someone who's managing something that they don't own, and it can produce better results like that.
Well, and I think the people that like ultimately work for you, like they see the like all of the stuff that Kevin and I do in the community that are like good for the community, and like they can feel good that they're part of it. Like we sponsor 50 free concerts every summer, like the outdoor band thing over like just $2 away from here, and like it's a very visible thing in the community, and people like see that I do that, and like I could name 10 things just like that, and like people feel good that they're kind of part of that mission.
Sure, that makes sense.
Yeah.
Going back to like, I guess investing passively, and I know you are on the GP side of things, but I think you're more filling sort of that capital role, correct?
Yeah, definitely not like doing day-to-day real estate stuff. We have like a meeting, probably a meeting a week, accompanied with a phone call here and there, and mostly involved with big decision stuff.
Okay.
But
what have you learned doing that you think like retail investors, if they're investing $100,000 here and there into individual deals, like what's some things that they could take away?
Yeah, I mean, if you're just doing the syndication stuff, it's really important to just understand the quality of the operator, and then like, really look at your paperwork. And what I really like to do these days is just, if you get paperwork from a syndicator, like run it through ChatGPT and say like, what are the fees? And then what am I paying relative to market? Like it's a really easy way to make it like more understand like okay, this is how this deal is structured. And then like, how does it compare to like what averages are for syndicators in the country? And then if there's a disconnect there, like you can see that right away.
I have one to add to that, which is what are conflicting terms inside of these agreements? Because sometimes the syndicators themselves don't even know that there's, something in the PPM that totally conflicts with the operating agreement.
Yeah. So using ChatGPT to like check the paperwork out is like everybody should do that. Like I know who the good syndicators and true followers are, but like if I didn't know, like I think my play would be to like go like look at their properties and like call their property managers, be like, hey, I'm thinking about renting an apartment here. Can I get a tour? And just kind of see how that experience is. And that tells you a lot about how they ran, right? So what like independent research can you do more than just like meeting with the sales guy and having them tell you they're great? Like, because obviously everybody's going to say that.
Of course. Absolutely. Adam, I don't know. I've been asking a lot of questions here. Anything?
I think you can keep going, but I want to touch on one thing that you said, and maybe this is more of a comment than a question, but so often we see investors go into a deal that has a 5-year life cycle or something. Maybe that's just what they think all the deals are, or they think, hey, I want this high RRR. But you just mentioned some things that really align with what we do and what we've seen a lot of successful people do over the last 40 years is long-term buy and hold with good debt. And so even you saying, hey, I don't want to go and flip these properties. If you went and talk to most syndicators, that doesn't match what they're selling, right? So kind of that alignment piece of your personal investment philosophy matching what the syndicator is doing.
Yeah. I think with syndicators, like often like there's this expectation of like at the end of 7 years, we're going to sell this thing in whatever. I know that if I sell, like we have a building here in town that somebody offered us a little bit too much money for, so we're probably going to take it. But I know that like when I get my $2 million back, like I've got to go find a place to put it, right? So if you have a good asset, like there's no point to sell because you're going to have to redeploy that money somewhere else.
What created that kind of thought in your head, right? Because I think the broad spectrum is flip every 5 years or so. What led you down that path of buy and hold?
Yeah, I do think it is, every 5 to 7 years, like sell and I think that probably comes from like individual LPs and that syndicators work with that like want to see their money come back sooner than later. It's easier to take a long-term perspective, like when you're sitting on cash and like don't need the money back. So like that's definitely part of it. It's like you don't need the liquidity, but also like there's great investments and you just don't want to sell them, and there's stuff that you kind of wish I hadn't bought that, but you're kind of stuck with it.
Better to regret the property you didn't buy than the one you did.
Yep, 100%.
Well, I guess to kind of pivot away from real estate, I've got some, I guess a general business question. I know, MarketBeat's grown from, I guess, what was essentially a side project, right? That originally started, you guys have now crossed 50 million in revenue, and you've raised no outside capital, right? That's completely bootstrapped.
I did get $5,000 grant in college from the local economic development people to start my business. So thank you to the Lake Area Improvement Corporation in Madison, South Dakota. Thankfully, they did not ask for equity. They just gave me $5,000. So no outside capital other than that.
Okay. Well, I'm curious, we've got entrepreneurs that listen. I mean, that's a massive level of growth, right? So like, what were sort of the key inflection points? If you sort of get to a certain level and plateau and you go to the next one, like what did that look like in that journey for you?
Yeah. First real inflection point was like, so MarketBeat as a business really started in 2008. It took 3 years to get to 6 figures in revenue. But then we pretty quickly went from 6 to 7 figures in revenue when we figured out how to do like financial content creation at scale, which meant like whenever any public company announced their quarterly earnings, like within an hour, we'd have a story out about it, and we used tech to make the content. This is like, before AI was a thing, but, we could take like a 10K form from a company, extract all the key pieces, make an article out of it, publish it. So then we could go publish, hundreds of articles today. So every time there was like an insider transaction, we would publish a story about it. Every time a company announced earnings, there was a story about it. Anytime analyst recommendation, buy or sell rating, like we'd write a story about it. So that like allowed me to create 100 or 200 articles a day without like having writers, which that got me from like the 6-figure mark to the 7-figure mark. And then it wasn't until like 2020, 2021, like COVID, where we got to 10 million in revenue. It was probably 2020 when that happened. And I think maybe it was 19, but it was around then, like during like that meme stock kind of boom, or if we're talking AMC, GameStop. Well, like a year before that, I had built out pages for like every company, and then like followed by the word like short squeeze or short interest. So that when like those keywords like were the thing to search for, like there was MarketBeat, and that was fantastic. Like, we had days where like we had more than 1 million page views on our website, which like today we don't even get that. So like we just happened to be like right place, right time on some of that stuff, and definitely took advantage of it and was able to use that. More recently in like 2024, 25, we've had a big push into SMS and a big push into YouTube. Like email deliverability is getting a lot harder because there's just a lot more spam on the internet, and what the ESPs are looking for out of email senders is getting tighter and tighter. So if it's harder to like get your email seen in front of people, that told me we should look at different channels. So we started collecting SMS opt-ins, and like that's been huge for us. SMS is like 1/3 of our revenue now. And then doing a YouTube channel, which has grown significantly, like that's up to 600,000 subscribers, going pretty well. We're building out a studio for that. So really like the name of the game these days for me is just like, we have all the advertisers we would ever need. And like we could send them twice as many customers and they'd be perfectly happy. We've got a good amount of like email signups and like investor attention. Now, like really the game is like, go find some new channels that like you just haven't seen before. So like last year we tried to do a Substack, because like, yeah, Substack is an email newsletter, but it's also kind of its own platform. So maybe we should try to do something on Substack, and like not everything works, but we just try to be in as many places as we can that make sense and will generate revenue for us.
Sure. Sounds like there's a lot of preparation in trying to position to be in those right spots, and I guess preparation and experimentation, if I could sum all that up in 2 words.
Yeah, there's definitely a lot of just trying stuff and seeing what sticks.
Yeah.
And then eventually like you figure something out, and
Sure.
then you just do a lot more of it.
Sure.
It's like we went from like 1 YouTube video a week, and now we're at like 5 and a live stream. So just if you find a thing that sticks, and you just do a lot more of it. And usually that works to scale.
Sure. Well, I know I'm trying to be mindful of time here. I know I'm curious your thoughts on, I guess, asset allocation, but also time allocation, because I know, you've got wealth across a company and venture capital, which we haven't even talked about, in commercial real estate. And like, how do you think about the allocation of both your wealth and your time, and kind of how's that shifted over time?
One thing that I've realized in recent years is like there are some things that are just too small to mess with these days. So like for a venture investment, like personally, like if Matt's going to write a check, like the smallest check I'm going to write is probably about $500,000 now. Like if it's below that, like somebody wants 50K for their startup, it's just like, that doesn't move the needle. Like I just can't do it. Like I don't need another K1 form for that. So really like just setting a minimum, like on like, it's either it's this size of check, or like I'm just not going to mess with it. Like that's been a really good change for me. The real estate stuff doesn't take a ton of time, thankfully, but like it is very scalable, because like there's a great team at Creston that does, property management and does our financing, all that stuff, right?
Sure.
The VC stuff has been like, I enjoy it, but it is kind of a time suck. So like, I don't know 10 years from now if I'm still doing that or not. Like we'll kind of see how it goes. Like if it goes awesome and we generate great returns, like I'll probably keep doing it. If we, just have a bunch of liquid stuff and like there's no clear end in sight, like it's like, okay, why am I still doing this? So, we'll have some real visibility in that in the next couple of years. It's kind of a 5 to 10 hour week deal for me right now. Most of my time is still at MarketBeat, and I do like working a lot. So like, I don't really mind that the meetings stack up. I mean, you guys are like my 5th meeting today, but like, it's fine. Like I dig it.
That's incredible, given that it's only about 4:00 your time, right?
I had 2 VC meetings, had a lunch meeting, had a meeting related to the Rotary Club I'm a part of, had a meeting with an employee, and now we're here. So
Well, on the VC side, I mean, I'm curious, have you been happy with that? Has it been a decent hit rate? And then maybe as compared to real estate, like what's the risk return? I know obviously it's a completely different profile, but have you been happy with what you've been getting there?
I mean, it's on the totally the opposite end of the risk spectrum, right?
Yeah.
So it's high risk, high reward. So we've had two funds in this in homegrown capital, about 40 million under management between the two. So not a huge VC firm by any means, but for a firm in South Dakota, like still a very decent size. We've got like 15 portfolio companies, maybe like 17 now. We've only had one company like really go belly up, and that's because they were burning too much money. But like the other companies are going pretty well. Like have a couple that'll be really nice exits in a year or two. Like it should be good, but you never really know until these companies sell, right? So
Yeah.
we'll see how it shakes out. Like I'm optimistic about it, but I've seen great deals like totally like fall over flat. I've seen like things that you think are like going to zero totally turn around. So just you don't really know until like the check's in hand.
Yeah.
So it's something you gotta love to do, because I think globally like VC returns are probably not there unless you're in like the top 1% of funds. But like if you love it, like you can do okay with it.
Sure. Is it more of a labor of love in some ways, just for you to be able to support local businesses and things that are more meaningful to you simply because of the proximity to it?
Now, I think it keeps me sharp because like you get to like see a ton of presentations, ton of pitch decks, a lot of meetings. You get to like identify like here's why this business works or doesn't work, and like you can take stuff home like to your main business from that. So like it's fun to see the inner workings of companies. It's fun to like be on boards and like share the wins and losses with founders and like give them advice and see how the advice pans out. And like that part of it I love. Like you kind of feel like you're it's almost like you kind of own a sports team and you're rooting for them and you're wishing them well, and like you give them advice, and like you can't always control whether they win or lose, but like you're there for it and you love it.
It's really good. Adam, I've got two more questions, including the question we always ask. So I don't know if you got
Go
anything
ahead.
else. Okay. So Matt, there was a tweet you had recently that I bookmarked specifically to ask you about. It was you tweeted that I'm paraphrasing here. Your 30s were about exploration, and your 40s are going to be about execution on what you learned. And so I'm curious, like what that looks like, and maybe like what are the things that you're going to be saying no to, and kind of how, and then where are you doubling down?
Yeah. So like people that like only know me recently, like I did a lot of stuff in my late 20s, early 30s. Like I went to seminary, got a seminary degree. I taught computer programming at the university that I went to. Like I taught web programming classes. I had a ton of different internet business ideas. Like a long time ago, I tried to invest in single family homes and like realized this is a terrible idea. So like I tried a bunch of stuff and like figured out like if I just double down on MarketBeat, like that's the best way to go. So I also I don't know, like I also realized like I'm not a great nonprofit board member. Like I was on some nonprofit boards and like we just got frustrated because like I was always frustrated that things weren't moving quickly enough. And I was the entrepreneur but owned a China shop, and like, oh, maybe I shouldn't be on boards and I should just give checks and kind of keep my distance. So I think the things that I'm saying no to are like, obviously not going to start another business because that would just probably cost me money. I'm not going to say yes to being on nonprofit boards, but definitely like encourage my employees to do that. And just don't do, when you're in a small community like Sioux Falls, it's 250,000 people, and you're like one of the bigger, more established names. Like you get a lot of inbound for like, you should come to our thing on Friday night. That's a fundraiser for XYZ. And it's like, well, how about I just write you a check and I'm going to stay at home with my kids because like I don't really want to go to that stuff. So you kind of have to be like in a small town, you have to be militant. You just kind of not like a jerk, but like you just get invited to so much stuff. It kind of becomes noise. Like
Sure.
Every week there's a different gala for something, and just like, guys, I got little kids at home. I don't go to gala. And so like it's easier to reject things as a category. Like, yeah, I don't do evening events. Like, and then just kind of like say that to everybody, and then they don't feel like they're personally rejected versus like, oh, Matt just doesn't do evening events. Or like people who do these like 7:30 breakfast and like, guys, I walk my daughter to school at 7:45 every day. So sorry.
Man, I think that you could extract a lot of stuff out of that. I mean, setting boundaries and like knowing what's important, but then also like being willing. I think this goes back. It sounds like it's a little bit of an extension of what you did with MarketBeat, right? Like trying a lot of different things and seeing what sticks. And then now you've got the experience, and it's easy to turn around and look and say, okay, well, that didn't work, or I didn't enjoy that, or I wasn't good at that, so I'm not going to do that anymore. But I am going to focus on the thing that I do enjoy and that makes me the most money.
Yeah. I mean, what I've realized is like when I kind of let the world set my agenda of like the things people want me to be involved with, like I end up saying yes to too much, and then I end up having like you don't have time to go to the gym, you don't have time to relax at work, and like that's just not good.
Sure.
It's like I've got to really be careful about what I say yes to, because otherwise I'm giving away like my free time and my gym time and that kind of stuff. And
yeah,
he doesn't want to come to our breakfast gala, is what I'm hearing, Dustin.
Yeah, Matt,
I'm out.
We won't send you a invite to our next breakfast gala. Last question we ask every guest. So we're the Wealth Independence Podcast, and then those words, independence and freedom, and it's a big part of what matters to Adam and I. We ask all of our guests, what do those words mean to you? How do you manifest that kind of in your everyday life?
Yeah, I mean, to me, wealth is just optionality of like being able to do the things that you want to do. When I was in college, like I could basically do whatever I wanted other than like, do homework, and like I had so much freedom back then. Like I had more freedom then than I do today. So I don't know like what I'm doing wrong, but like back then nobody depended on me. And now a lot of people depend on me. So I think in a way I'm failing at the independence thing. So I don't know. I think about that like often, like before I like had a job or like a business, and like nobody depended on me, and that's kind of nice. And now a lot of people depend on me, and I just end up working all the time. So I think I've got some introspection to do there, because it would be nice to not have 6 meetings a day.
Sure. But I think at least it sounds like with, again, going back to the tweet about exploration versus execution, it sounds like you're making progress towards that, though.
Yeah. And it's like, it's an ongoing battle, right? Because every day there's a new email in my inbox of like, hey, I'm running for city council. You should tell me how to like win my race. And just like, fine, I'll meet with you. And just like, you just gotta keep up the discipline to say no to stuff.
Yeah. Well, Adam, any final questions?
No, I appreciate you being here, Matt.
Yeah, Matt.
Happy to come on, and look forward to seeing this come out, and appreciate what you guys do.
Absolutely. We'll let you get back to whatever's after this is the 17th meeting of the day. So we'll let you get to that one.
All right. Sounds good.
Thanks so much for joining us.
Yep.
All right. Well, that lived up to what I was hoping it would. I feel like we could have kept talking for quite a while, and I obviously could have asked a whole lot of other. My natural curiosity is just going off the charts here, right?
Yeah, but, I think you did a good job of not digging super deep into his email marketing, because I think I don't think you cared about anything else. You just wanted to ask about email marketing, and you kept all the questions away from that.
The email marketing, and I'm definitely curious. I mean, for our businesses, the shift he's seeing from email to text message, and they're building a YouTube channel is shocked there. I think over, what do you say, 600,000 followers. So there's subscribers, to use YouTube parlance. Massive following, but yeah, I don't know. Adam, any big takeaways from you?
I mean, I have notes kind of written all over this page here, but I mean, I'll start in the beginning. Not in the beginning. I'll start and see where I go. The first thing is that he made a joking comment, but I think it's really important. He said that he got a municipal grant. Thank you. I wanted to say bond. It wasn't a bond. He got a grant from the local municipality to start the business for $5,000. And then he joked. He said, luckily they didn't want equity. I think so many people are willing to give away equity really early on in the business, and they don't do the calculation to what that will cost them should they get to the success point they want. I mean, structure it as a loan structure. I mean, he made $50 million of revenue this year. imagine if they had taken 20%. I mean, he would have been funding the municipality more than I think he currently is with tax revenue,
The
right?
taxpayers.
But you just imagine it wasn't a municipality. Imagine it was your college roommate who wanted half the business or something. Oh, sure, have half the business. It's a freaking newsletter worth nothing. Like, he would be giving away a ton. So I think that's the first thing. Second to that are some of the things he talked about. Wealth is really just giving him the opportunity, right? Not opportunity. He said optionality. That's how bad my notes are. I can't read my own handwriting. It says optionality. I'm not going to pull it up. I'll show at some point how bad my handwriting is. And it's just the optionality to go do what he wants, right? It doesn't create, to a certain extent, he was saying, like, it creates more weight on his shoulder of things he wants to do. But at the end of the day, he has the optionality to go do the things he wants. Probably not saying no to the price of much. And then, but with that, he's created boundaries. And I think that was really important, right? I don't know how he schedules his day, but I personally work on Dan Sullivan's free focus buffer days. So a focus day would be where you're just working on a project, and a buffer day is where you're going to have your meetings, and a free day is where you're just going to go hang out, be with your kids, be with your friends, do whatever. And so I do 3 free days a week, 2 focus days, and 2 buffer days. So I try to get all my meetings on Mondays and Thursdays, and that tends to work really well for me. This is a project to me, so we do our podcast recordings on Tuesdays. So you build some structure, then you start to have all this more time in your life. And things like, it takes his daughter to school at 7:45 every morning. Back in my mind, says that's a security note to not air that publicly, but whatever, he did. He and he doesn't do dinners. You just write a check, right? If like they're not calling him because I'm sure they love him at dinner, but they're calling him because they want a check, right? Yeah. They're not calling him because we really love you and we need you at this gala. I mean, they might use that to draw other people. But at the end of the day, they're trying to raise money. So I think those are kind of the things I took out of it. And just that it's not, I think he's a good example of not timing the market, but time in it and being consistent, right? Because he said it took 3 years to get to $100,000 of revenue?
Yeah.
And then when did he start? The 90s?
2008.
2008?
Yeah.
In 2008, then it took another 10 years to get to 10 million.
Yeah.
And then in the last 5 years, he's gotten to 50 million, right? The growth just keeps going. And then the amount of things he's able to do. And then I think where I'll kind of cut this off and end for whatever other comments you have is that he understands that MarketBeats is not a long-term wealth building tool, but that it spits off all this cash and you go put that into assets that truly build wealth.
Yeah. I'm glad you ended there because that was the thing I was hoping to ask him about, that exact thing, and then he brought it up before I even had a chance to ask. But yeah, looking at separating the vehicle that provides cash flow versus the vehicle that provides like the long-term wealth and like what's going to provide for his retirement, as he said. I think that's important, and I like. That's something I had a post on LinkedIn recently about this, that like you're probably better off to use if you're looking at where to spend your time, you're better off spending your time figuring out how to make more money. So either learning upskilling, learning new things, or getting better at either your job or your business or something like that, than trying to learn investing specifically to like be this massive wealth builder. And I think this is an you and I know several people like this, right? Where they've got businesses that more or less the whole reason they have the business, and they obviously enjoy what they do, but the primary purpose of the business is not to be a vehicle for equity in and of itself, but to throw off a whole bunch of cash and then spit that off into investments that they're mostly passive in, right? Their time is generally spent figuring out how to make that business spit off more cash. And then they're throwing all of that into something else that's going to preserve and grow, and then will start producing cash on its own over there. And I think that, again, I wanted to ask about his view on like redeploying capital and all of this stuff. And then he kind of brought it up. And I think that's an important point that applies regardless of the level that you're at. If you got a $50 million a year business, or you've got a $500,000 a year W-2, like the concept's the same.
I think the only other thing that I would mention is just that it's funny to so I talked to a syndicator the other day about an apartment building that he's buying. And they've set the whole thing up to have a pref and to have this 75-25 split afterwards and 5-year debt. And they're going to sell it 5 years because they want to build a track record and they want to get this IRR. And I said, most of our investors are long-term buy and hold. And he's like, well, I'd love to meet some of those because all the ones I talk to want to sell after 5 years, right? They want a higher IRR. I've never met a very wealthy investor who cares about it. An exit in 5 years. Actually, most of the successful ones, and one of the ones that was in that conversation with me and that syndicator was like, I don't know that I would do 5-year debt right now because 5-year debt comes due in 2030. 2030 is when all the 10-year debt that was originated in 2020 comes due. And that's not the bridge debt issues we've seen over the last 2 years. That's just true, really expensive debt. So they might, coming due on great assets, but might be a lot of liquidity in the market. There might be a lot of people selling at that time.
Yeah, no, the long-term view that's, I had that thought too, that okay, here we've got another, very, very successful example of someone who does not take that, I need to be in and out of properties. And it's always, he specifically mentioned a thing that you and I have talked about so much about, now I got to figure out what to do with it, right?
Yeah.
And it's, some people, I feel like I've mentioned that to people and they kind of roll their eyes, but it's like, that's a legitimate problem, right? Like if you are rolling out of something and flipping in and out, the idea is to own assets, not to just have cash. And if you get cash back, that's a good thing, right? That is better than not getting anything. But at the same time, you don't want the cash, you want assets. So yeah, it was
assets and the cash flow.
Assets and the cash flow, exactly. So yeah, it was funny to hear him say that. And I'm like, I love hearing my thoughts come out of someone else's mouth, completely independently.
With an extra zero too on their network.
Yeah, exactly. Well, no, I think this is great. Any other parting thoughts?
No.
Well, good deal. Everybody, we appreciate you listening. If you enjoyed this, go give Matt a follow. Actually, I don't think we asked this in the
interview. But he's easy to find. It'll be in the show
very
notes.
Easy to find. We'll make sure that his website and his Twitter and all the other links are posted in the show notes. But definitely go out and give him a follow. If you're on Twitter, go follow him. It's entertaining at the least and educational at best. But we appreciate you listening. Again, if you like the show, go out, give us a thumbs up on YouTube, 5-star review on Apple Podcasts, and whatever it is you do on Spotify. And we'll appreciate that. Let the computers know you're enjoying it and get the message out to more people. But again, thanks for being here. We'll see you on the next episode. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.